So this is question P219, and it's just about understanding costs. So we have this company, RTW Company, which manufactures acoustic and electric guitars, and they've given us a bunch of costs, list of 10 costs. So as you're probably aware from reading this chapter, there are many different ways to slice and dice costs. So what I've done with these categories that they've provided is I've tried to color code them to show which are mutually exclusive. So within the yellow category of variable and fixed, if you have something in that category, it's either variable or it's fixed. It's not both at this stage. Okay, you'll see in a later chapter that there is something called mixed costs, but for this question, we're going to say that the two categories are mutually exclusive. If it's in one, it's not in the other. Same with direct materials, direct labor, and manufacturing overhead. If it belongs in this category, then it's one of the three and not two of the three. There's another category here, which is the orange, the product and period costs. It's one or the other. Either it's a cost of the product or it's a period cost like selling, general, and admin. Another way of looking at costs is by considering whether they are direct or indirect. And an element that's really important in making this decision is what is the cost object that you are referring to when you say it's a direct or an indirect cost. So the textbook itself used the units of product cost object. This one here, the manufacturing facility, is just an extra one I've added so that you can see that some costs, for example, could be indirect to the units of product, but are direct to the manufacturing facility. So again, the categorization hinges on what is the cost object that we're considering when we're making the classification. And then there's these two other types of cost, an opportunity and a sunk cost, and we'll see those when they come up. Okay, so let's look at the very first one. The guitars use metal for the frets and tuning knobs that cost $10 per guitar. So when you see per guitar, that's obviously a variable cost. It's not fixed because it depends on the number of guitars that are made. Okay, so for the yellow category, we definitely have a variable cost. Is this cost a product or a period cost? The orange categories, that's our next decision. And clearly, because the metal is for the actual products, the guitars, this is a product cost, okay? So it's not a period cost. Within the product cost, are we going to classify this cost as direct materials, direct labor, or manufacturing overhead? And I think it's pretty obvious that it's materials because it's the metal that you use in the frets. Okay, next, we're going to look at this category. Is it direct or indirect to the units of product? Well, because we can tie that metal to each individual guitar, that's a direct cost of the product. And from the manufacturing facility's perspective, is that directly related to the operations of the manufacturing facility? Yes, so it's a direct cost of the manufacturing facility. Next cost, wages for employees who handcraft the guitars, total $175 per guitar. Again, you see the per guitar and you know that's a variable cost, not fixed. It's directly related to the guitar, so that makes it a product cost in this orange category, and we're going to further subdivide between the three green categories. And wages are clearly direct labor, so it falls into that classification. Now on to whether we have direct or indirect costs to the unit of product. So the wages for the employees who handcraft those guitars, obviously that's a direct cost because you can tie those wages to each individual guitar. And same thing to the manufacturing facility. Those employees work at the manufacturing facility, so they are direct costs of the manufacturing facility. Third cost, insurance on the manufacturing facilities totals $5,000 per year. So it doesn't matter how many guitars you produce, the insurance stays the same. That means it's a fixed cost, not a variable cost. Is the insurance on the manufacturing facility? Is that a product cost or a period cost? Well, since it's directly related to the manufacturing facility in which those guitars are produced, we're going to consider it a product cost. Which of the three? Well, you can't directly tie the insurance to individual guitars, so we're going to call that overhead, manufacturing overhead. Okay, is it direct or indirect to the units of product? Again, we can't tie it directly to the guitars, so we're going to classify it as indirect. But for the manufacturing facility, this is a direct cost of the manufacturing facility. You can tie that insurance premium to that manufacturing facility. So for the manufacturing facility cost object, insurance is a direct cost. Okay, glue used in the assembly process amounts to $3 per guitar. Now, as you can see, we've got the per guitar notation here, so we're going to call that a variable cost. However, and because it's per guitar, it's clearly a product cost in the orange category, not a period cost. So that's fine. However, when you're assessing whether a small cost like this, $3 per guitar, it looks like supplies. It could be considered a direct material, or I think what they're trying to imply here is a manufacturing overhead. Indirect, you don't usually track, oh, I use like 10 grams of glue on this guitar and 13 on that guitar. So that's why we would often use the overhead category for materials that are used in very small amounts. Okay, let's think about the direct versus indirect nature of the cost related to the guitars. In this case, because the glue is used directly in the assembly of the guitar, we're going to call that a direct cost. And for the manufacturing facility, again, it's used in the manufacturing facility, so it's a direct cost of the manufacturing facility. The annual depreciation cost of the machines used to cut and finish the wood used in the guitars. Okay, assuming depreciation is time-based, so for example, over a 10-year period, and the machines don't depreciate based on each guitar that they process, we're going to call that a fixed cost, because it just depends on how many months have passed. That relates to how much depreciation you will actually charge. It is related to the place where the guitars are manufactured, so it's a product cost, and it's clearly overhead because we can't really tie that depreciation to the individual units of guitars. Direct and indirect, again, because it can't be tied to individual guitars, we're going to call that an indirect cost of the units of product or the guitars, but still, it is a direct cost of the manufacturing facility because we can link it directly to that manufacturing facility. Okay, the salary of the VP marketing is $150,000 per year. Now, that cost is fixed, right? They're not suggesting that we pay him more or less depending on what the sales are. Commissions might be treated differently, but this is a fixed cost. Is it related to the product? I mean, no, I would call the salary of the VP marketing a period cost because it's related to selling and admin. So this is our first period cost. Therefore, it doesn't belong in any of the three product cost categories. Is it a direct or indirect cost of the units of product? I think we're going to say, you know what? It's unrelated. Because it's not related to producing those products. They're also, your VP marketing is unrelated to the manufacturing facility. I mean, I'd think here of a little org chart. We have our president. We have like the VP marketing. We might have the VP operations over here. And under the VP operations, we might have, manufacturing facility 1. This is for guitars. And they might have manufacturing facility 2 for pianos. I'm just making this up. It's not that it was in the question. So the VP marketing, our cost object for the manufacturing facility would be anything that happens under this box. The VP marketing is just not related. It's just really far away. Their span of control is over here, just not related. Okay, so let's go back. The salary of the manager of the manufacturing operations is $120,000 per year. We're on cost number 7 now. That is a fixed cost of the manufacturing operations because it's a salary. We do need a manager of manufacturing operations. So even though we can't tie the manager to individual guitars, we can tie the manager to the production of guitars. So this is a product cost, and we'd include it as part of manufacturing overhead. It's not part of selling and admin. Okay, is it a direct or indirect cost of the units of product? Well, it's indirect, again, because we can't tie it to individual guitars. But to the manufacturing facility, yeah, that's a direct cost of the manufacturing facility. If we go back over here, we have the manager salary under here, under the manufacturing facility. So that's a direct cost there. The total cost of an advertising campaign paid at the beginning of the year just ended was $75,000. Okay, what they're trying to get at here is a sunk cost. So whatever we decide going forward, there's nothing we can do to get this $75,000 back. It's a sunk cost. Our decisions on how many guitars to produce, how successful the advertising campaign was, we make those decisions on a look forward basis, not on as if we could recoup that money. So that makes it a sunk cost. Okay, I would also consider, if I was looking at it from a different perspective, the cost of an advertising campaign would be fixed. It's a fixed cost. It would be a period cost because it's related to selling. So I would call that a period cost. Would it be direct or indirect to the units of product? Well, if the advertising campaign is for the guitars, I would say it's an indirect cost of advertising the product of the guitars and therefore to the manufacturing facility. Okay, this next one, number 9. Instead of producing acoustic guitars, RTW could use the manufacturing facilities to increase production of electric guitars that would generate operating income of $100,000. What they're getting at here is an opportunity cost. Instead of doing this, we could do that. And because we're not increasing production of electric guitars, there's an opportunity cost of $100,000 per year because of that. Okay, finally, overtime premiums. So this is one which is a little gray. Overtime premiums, you would think, you could argue, they're variable because it depends on the number of hours of overtime that people do to generate that 1,000. So you could consider that a variable cost. So I'm going to include it in variable cost here. But you could argue that it's a fixed cost in the sense that overtime is not a necessary cost for producing guitars. It just relates to the specific circumstances they're in this time. They had a rush order on a specific model of guitar for this big customer. They decided to do it. So you could say that's a one-off fixed cost. So I'm just going to put it in red here. It's a possibility, depending on the context, how you want to justify that. Same thing for the product cost. So if we're calling it a variable cost, we would call it a direct labor cost. But if we're saying, look, this is a fixed cost, a one-off thing, then we'd argue that it's manufacturing overhead because of that one decision to run over capacity at that one point in time. Compared to units of the product, it is definitely a direct cost, and to the manufacturing facility, also a direct cost.